Hello, everyone, and welcome to our financial webcast titled Where to Invest in 2024, presented by Legend Financial Advisors. My name is Dan, the moderator for the webcast. Today's webcast presenter is Bill Knight, CFP, AWMA, PPC, and Wealth Advisor with Legend Financial Advisors. Please hold as I turn the broadcast over to Bill.
Thank you, Dan. Hey, everyone. Thank you for joining today's webcast. Today, as Dan mentioned, we will be reviewing the where to invest for 2024, but we're also going to talk about some of the market conditions and the overall performance of the markets today and really over the past 17 months. And by the end of the presentation, what I would like for you to walk away with are a few different tools that you can utilize to make some more informed decisions and put some of this information to action. So with that, I know a lot of you are aware that the market has been making new highs. And so what our team has prepared are the index returns for 2023, just to provide some perspective in terms of some of the themes that occurred last year and that have spilled over into this year. So this first chart is performance information for indexes that we receive from Bloomberg. And there's a legend in the upper left-hand corner identifying what index is represented. And this is for the entire year of 2023. And what we're going to focus on really are some of the outliers here with, you can see the strong performance last year was undoubtedly technology, and that's represented by the NASDAQ. The NASDAQ was positive roughly 55% for last year, and then the next big performer was the S&P 500 being up around 26%. So with these two indexes, you have the NASDAQ, which is roughly 60% of that is in technology, and then the S&P 500 has about 30% in technology and another 10% or about 9% in communication services. And those are also companies that tend to have a large exposure to some of the artificial intelligence themes that were evident last year and still evident and influential today. A lot of those companies being companies like Google, Alphabet, and communication services, and then companies like Apple, Microsoft, NVIDIA that comprise the NASDAQ and really fueled the rally that we saw last year. And even towards the last couple months of the year, a big portion of the rally that we saw throughout most of the indexes was really due to some of the changes in expectations for fiscal policy. So the Federal Reserve came out and said that they are likely to start to decrease the federal funds rate for this year at some point in time. And today is actually one of the Fed's meetings, and they will be releasing information at 2 p.m. that will shed more light in terms of what direction they will be going in. But the general theme for last year and the main takeaways is that it was predominantly led by technology. Then there's a handful of indexes in the middle, whether that was bonds or other areas. And then there was some underperformance from commodities and the US dollar. From there, to provide a little bit more detail in terms of which sectors were really performing well, as mentioned, it was really the top performers being information and communication services. So those were the two leading areas that were the different sectors that make up the S&P 500. So you can see from this legend, we have all of the different sectors that make up the S&P 500, and the top performers were the technology area. Moving forward to this year, we see a lot of those trends that persisted last year continue into this year. So you can see that this is the performance from the beginning of the year through March 15th. And what we're seeing is the NASDAQ and the S&P 500 again have been leading the pack. And then in terms of the sectors, it's continued to be the same trend where we see communication services and info tech be the leading sectors, where we've continued to see somewhat of an underperformance from the utility sectors as well as real estate. So when kind of seeing all of this information and really kind of the cyclical or short-term bull market that we've been experiencing over the past 17 months, you have to ask yourself, what does this actually mean for you and your portfolio? And what we've seen is, and as you can imagine, is that there has been an outperformance based on exposure to technology and in particular to large cap growth companies. And what can happen in portfolios is that those particular positions can become too large of an overall position, depending upon what your tolerance for risk is. So that creates some opportunities because obviously we're in a market where we've experienced several new highs so far this year, whether it's the NASDAQ, the S&P 500, or the Dow Jones. And that's certainly an opportunity to take some profits off the table. Now, one of the items I wanted to share with you is from a software we use from Morningstar. And this is a software we use for managing our portfolios. Now, this example in particular is not representative of a portfolio that we manage. This was an example that is a good representation of a portfolio that has become overweight in the areas that we have seen, like technology, like communication services, and that's where it creates an opportunity for some potential rebalancing if that's something that is an appropriate fit for you. So this type of analysis is something that we utilize for our portfolios. You can see that this particular analysis is for the stock portion of portfolios, and it gives you an idea where the majority of your portfolio trends in. So this portfolio, for example, has a little bit more exposure to cyclical stocks, and it provides a breakdown of each of the underlying sectors. And we typically try to identify any of the sectors that have more than 20% or so in one of the particular sectors, because then it becomes more overweight and more of the overall return, whether it's good or bad, will be dependent upon those sectors. So this one in particular would have a heavier exposure, obviously, to technology with roughly 28%. And then there's also a lot of exposure to communication services being similar to technology, just because companies like Meta, companies like Google, Alphabet are in this category. A lot of the same types of companies that have been exposed to the big rally in artificial intelligence. So those are one of the things that we have seen when evaluating prospect portfolios, for example, is a lot of these areas are starting to become very large as an overall component of the portfolio. And then one other interesting part of this type of analysis is it also does provide a breakdown of where the underlying companies in your portfolio are spread out. So you can see that this portfolio in particular is primarily in North America, with roughly 80% of it in North America, and then spread out throughout the rest of the world. Now, the next illustration that I want to share, this is also from Morningstar, and it is called a stock intersection. And one of the other themes that we've seen since companies like Microsoft, Apple, NVIDIA, really the Magnificent Seven that we saw last year, are becoming larger and larger pieces of some of the indexes that are more common, like the S&P 500, like the NASDAQ. And what you start to see over time is, since they're becoming so large in size, is that it is more and more common to find those same companies in a variety of different funds. And oftentimes what we see is when we will evaluate a prospective portfolio, we'll see portfolios that will have a number of different either mutual funds or exchange traded funds that will have different types of positions, but often you can have a lot of the same underlying companies be a part of those funds. And this is what this illustration shows. So for example, we ran a stock intersection for a portfolio we evaluated, and it showed us that the underlying top stock of all of the accounts was Microsoft Corporation. And it was actually in 17 of the different holdings that this individual had. So that is something where we would typically like to see no more than 2, 3, maybe a handful of positions hold the same underlying companies, because ultimately what you want to try to achieve is more effective diversification by owning different funds. And in the example that we're seeing here is we have Microsoft being represented in 17 different funds here for this particular portfolio, and Alphabet being in roughly 13 different funds. So it's always a good time to identify how much actual diversification you have by owning different funds in the portfolios, as some of these underlying stocks continue to grow in size and become a larger component of a lot of different investment options. So from there, I wanted to talk about some of the current economic conditions that are present today. And a big part of what we're going to see today with the Fed announcement is going to be the future direction that they are communicating to the market. And that was part of the big rally last year starting in November. And that's also part of some of the pullback in the bond market that we experienced so far this year. And what we've seen is that initially at the end of last year, the expectations for this year were for 6 rate cuts. And as inflation was a little bit stickier than anticipated, and what that means is not coming down as fast as the Fed would like to see, and as unemployment has remained strong, that has changed some of those expectations, where the current expectations are for 3 rate cuts. So right now, the Fed funds rate is at 5.25 to 5.50%. That's an area where they are trying to make financial conditions restrictive enough so that inflation continues to come down and meet their ideal target of roughly 2%. And so they have committed to keeping that the same for right now, but they have indicated that they are likely to lower rates later this year, and we'll have more feedback later today on that. So what they are viewing is inflation, and inflation right now, the consumer price index is 3.2%, and that is the number that they are viewing. But more importantly, in terms of what they keep track of, is the core CPI, and that is at 3.8%. Now with core CPI, the difference with that is it removes energy and food from the calculation, because those items can be a little bit more volatile, and there can be certain conditions like the weather that may have influences on those areas that may not necessarily be a good indicator of what is going on with the economy. So the Fed pays a little bit more attention to the core CPI, and that is one of the items that they're looking at and want to see to continue to come down. And aside from that, they keep a close eye on the unemployment rate. Now, this is something that recently has been ticking up in recent months, so it's something to take into consideration in terms of the strength of the economy. But for the most part, we've had strong employment numbers, and we've seen consumer spending that continues to be resilient, and much more so really than what economists were expecting, in particular for last year, but even for the first couple of months of this year. From there, we're going to talk about some of the market and economic risks that are present today. And one of those items that we're going to touch upon is the yield curve. Now, this is something that inverted roughly 16 months ago. Now, a yield curve inversion is an economic indicator, and it's something that has accurately predicted 8 out of the last 8 recessions. Now, it's not always 100% accurate. There was a time frame in 1966 where there was a brief inversion that was not followed by a recession. But the general idea, and you can see this text, and this is an illustration from Leuthold that we use, and it says that recession warnings are triggered when this measure trades below 0 for 10 consecutive days. So this is the 0 line here. So it's typically predicted a recession if it trades below that for 10 days. And we are 16 months into the yield curve being inverted. Now, the typical lead time is anywhere from 10 to 12 months. And if that would have been true, we would have had a recession starting last September. But that has not been the case. This has actually been one of the longest periods of time that we've had an inverted yield curve like this. So we'll see whether or not this ends up being a false signal or not. But in the past, it has been pretty accurate. So that is something that we just continue to monitor. And typically what you see with these past yield curve inversions is that once this starts to go back up is when you can have more of a recession-like environment. So that is something that we monitor. It's something that we're aware of, but we're also aware of other trends, and we'll talk about that in the next chart. So I know one of the questions that was brought up for this webcast was whether or not we are in a bubble. And we always keep in mind valuations. Now, valuations aren't always the best tool to use when it comes to a timing, making a move based on timing. However, it is good for historical perspective to understand where you are today in relation to different periods in time. And this is another illustration that we're using from the Leuthold group. And this basically shows that it's showing the price to earnings ratio, which is a measure of value. And this is for the S&P 500. And they've used a 5-year normalized earnings per share for this calculation to kind of smooth out the numbers. And the way this is set up is it's identifying the different peaks in the markets over time. And what they were trying to do is identify what is kind of that range in terms of the PE ratio, 5-year normalized, that would indicate that you're getting into bubble-like territory. And they use 30 as that number. Right now we are at 29.4, and that's as of March 6th. So it is something to be aware of. Now, it's common to hear that, bull market rallies can often, and even when you're in a bubble-like period, they can extend for further than you're actually comfortable. But it's just something to be aware of in terms of where valuations are at today, because the only other 2 time frames historically where valuations were at this level were the previous high, which was the end of 2021, beginning of 2022, and that was before the drop in 2022. And then aside from that, we have the tech bubble in the 2000-2001 time frame. So that is something to be aware of. But as mentioned, we have seen strong consumer spending, and other items to be aware of is that we've also seen an increase in spending on credit cards, and there's also been an increase in spending on buy now, pay later type services. So those could be items where people are spending a little bit more than they can handle. So that's also something to be aware of. So those are a few of just the items to be aware of in terms of any potential risk in the current market conditions. Now, when it comes to what are the opportunities that we are seeing today, there's a few of those that we'd like to share. And one comes back to another chart from the Leuthold Group, and this is another chart showing valuations. But this is showing valuations for small cap companies relative to large cap companies. And the way that this works is the center line would basically identify when there's an equal valuation among the two. When you go below this red line is when small cap companies would be undervalued relative to large cap companies. If you go above this line, it would show you that large cap companies have more attractive valuations. So we are at a time frame today where small cap companies have a more attractive valuations by about 20 to 25%. And medium-sized companies are in a similar range, not as attractive, but still more attractive relative to large cap companies. So this is where we are, and you can see that if you compare this to where we've been historically, the last time frame was during the tech bubble. And then also what you're seeing here are these blue shaded areas. These are the areas that mark recessions that have occurred in the economy. And one of the interesting parts about seeing this opportunity and when we evaluate portfolios is more often than not, the one area that most people are most underexposed to or have the least amount of their assets in is actually small cap companies and medium-sized companies. So that's certainly one of the areas of opportunity that we have seen not only today, but over the past few years. And we actually started making some changes back in 2022 just to better diversify some of the portfolios and make sure that we have a proper exposure to some of these areas that do have more attractive valuations, because ultimately, when you have a more attractive valuation, what that is saying is that over the next, let's say, 5 to 7 years, you should have a higher expected return. Whereas some of the large cap companies and really some of the indexes that we spoke about in the beginning of the presentation, like the NASDAQ, like the S&P 500, that are more rich and historically overvalued, what that is saying is that in the future, it's more likely than not that their returns are going to be lower than what has been experienced in the past. And then in terms of other opportunities that are present today, just to kind of recap a few different ideas. One, it's always smart to identify what your desired level of risk is. Now, given the run up in the markets over the past 17 months, what happens if you don't have rebalancing in place is that you can end up taking more risk on than what you were initially intending for. So it's always a good time to identify the level of risk that you want to take in relation to the amount of return that you are expecting. And we'll provide you with a tool in the next few slides here. In addition to that, another item that we've touched upon is rebalancing overweight sectors and positions that may be heavily influencing the portfolio, it's always an attractive opportunity to take some of the profits off those areas when they are performing well. In addition to that, being able to utilize non-correlated assets, we have a few listed there, such as gold, commodities, bonds, and more. Commodities, for example, had performed really well during the downturn that we experienced in 2022 and was one of the top performing asset classes, as were trend following funds during that time frame. Those are always strong diversifiers. Gold is a strong diversifier, especially if we were to enter something like a recession down the road. And then bonds. Bonds are in a period of time where they're more attractive today than they have been in the past 20 years. And right now it's common to see money market funds that are yielding over 5%, and even it's often to see CDs, for example. A lot of people ask about CDs and some of the attractive rates of return there. And one important to note is that studies have shown that roughly 3 months before the Fed starts to lower interest rates is when more traditional bonds will actually outperform some of their counterparts, like short-term money market instruments or just short-term bonds in general. So it's certainly a time frame to consider what types of bonds you have in your portfolio and what the overall strategy looks like for that portion of the portfolio, because once interest rates, and on the long end of the curve, once interest rates start to go down, there will be additional capital appreciation experienced by more traditional bonds. And that'll be something that will help it outpace some of the short-term bonds over time. Because once the Fed starts to lower interest rates, those short-term bonds will start yielding less. So that's one consideration, and something that we have been adjusting how we have approached bonds over the past year and a half, and have been incorporating more traditional bonds into some of our portfolios where it makes sense. Now, aside from that, I just want to touch upon some of the tools that you can use to make more well-informed decisions when it comes to your portfolio. The first takes us back to identifying the proper level of risk that you're taking in your portfolio. So whether you are in a life transition, whether it's transitioning into retirement, for example, or you just feel that it's the right time, that you might be becoming maybe a little bit more conservative, we offer a free risk assessment on our website, and that is legend-financial.com. And this is the area you actually go to, the free one-time services that we offer, and there's a risk assessment portion there. And that will actually take you to the next page, which brings up a software that is called Nitrogen, and it helps you find a risk score. So it's actually a number from 1 to 99, and it will help identify the right number for you, and that basically will let you know, how much amount of your money you should have in equities or stocks versus bonds, and help you have something that's in alignment with what you are looking for. So that's something that's very helpful that we've found, and it's a great exercise. It typically takes 10 to 15 minutes, and there's about 10 to 12 questions that you can walk through. In addition to that, one other tool that I touched upon a little bit earlier in this presentation is the Morningstar Advisor Workstation software that we use. And we earlier talked about the area for stocks that we can provide this analysis for. And what this does is, it really is a long report. They can be 50 to 70 pages in length. This is just one high-level overview that it offers. but it helps you identify what your current asset allocation is. It provides a breakdown of the bond analysis in your portfolio, if that's applicable for you. And it also provides a breakdown of the stocks in your portfolio. And it's always nice because we can immediately see some of the different trends that are occurring with the assets you have invested. And just looking at the breakdown, for example, with the overall sizes of the companies and in the exposure to growth or value companies in your portfolio. So for us, this would be a red flag to address and make sure that there's more exposure in small cap companies or medium-sized companies, and that not everything in the portfolio is dependent upon large cap growth companies, which is really one of the areas that is the most overvalued areas of the market. So these are some of the tools that we like to use. They can shed a lot of light for anyone that we use them for. So feel free to reach out to us if that would be useful for you. And since we just approached just over a half hour, we will go to the Q&A. So for anyone that has questions, please feel free to ask those, and we will cover any of your questions. So one of the questions that was asked for the presentation was whether or not we're not in a tech bubble, so a technology bubble. And with one of the slides we discussed earlier, that was specific to the S&P 500, but we're really seeing similar valuations, if not higher valuations for the technology area, like the NASDAQ, for example. Valuations have been higher, and it's more likely that there's a little bit more speculation in that space, just given the rally and a lot of the companies that are affected and utilize artificial intelligence. So it's certainly approaching that type of area. We won't really know until years down the road whether or not we're actually in a bubble. But it's certainly something where it's an important time to take some profits in that area if it makes sense for your portfolio. And it is something that we continue to monitor. One of the differences today with the technology space when compared to the technology period during 2000, 2001 is that the profit margins are actually a lot more attractive today than they were back then. And a lot of these companies that have been performing well do have more attractive profit margins and cleaner balance sheets, and for most part have been able to back up a lot of the speculation in their companies. So that's one item to take into consideration, but there's certainly outstretched valuations in that sector that we are paying attention to. So one question was explaining the strategy for adding bonds to the portfolio. And it's a great question. What I had mentioned earlier was that typically 3 months before the Fed starts to lower interest rates, it typically is more attractive to have more traditional types of bonds in your portfolio because their overall return will outpace that of short-term bonds. So for example, right now with money market funds, say they're yielding 5.25%, as the Fed changes their federal funds rate and lowers that over time, that will go down. Now with longer duration bonds, corporate bonds, more longer duration, government bonds, for example, those will move more based upon what happens with interest rates on the long end of the curve. And as that goes down over time, they will experience additional capital appreciation. So they will be having a more attractive yield, but they will experience capital appreciation as yields go down, their prices will go up. So it is advantageous to have additional exposure to those types of bonds. So that's something that we have added to over time when it has become more attractive in recent months, and it's something that we continue to evaluate. And we also make sure that we try to have a nice blend of different bonds in the portfolio, just because if you look at the past year and really the past 17 months as we've had this rally in the market, really the best performer has been floating rate bonds, which are below investment grade credit, but they are bonds that haven't been affected by the movement in interest rates increasing over this period of time, over the past couple of years. So those have been great performers. So it's certainly good to have a nice mix of bonds in the portfolio. All right. Well, if there aren't any other questions, I appreciate all of you who attended, and I will turn the presentation back over to Dan. Thank you.
Great, thank you, Bill, and I want to thank everybody for joining us and submitting questions. We hope you found the webcast educational and informative today. If you would like to schedule a free conference call consultation with a member of our advisory team, please call our office at 412-635-9210 to set up an appointment. Thank you again for attending, and this concludes the event.